What's going on, my market wizards? Today we are going to be talking about bonds and how they relate to other asset classes. Um, First of all, just make sure to like and subscribe this video, and we'll get started. So what is a bond? A bond is a loan made by an investor to the borrowing party. Bonds can be issued by individuals, corporations, even governments. Bonds allow those entities to raise money without going to a bank. Um, Bonds, also known as debt securities, were first issued in 2400 BC, and they allowed individuals, corporations, or governments to borrow money and make payments with a predetermined set of parameters. Bonds are important because they allow entities to raise money without having to go to a bank for a loan. Companies issue bonds to pay for expensive property, plant, or equipment in the same fashion that governments issue bonds to pay for infrastructure or even wars. If you look down here, you can kind of see a flow chart of how a bond is issued. The government or entity creates that bond, then it goes out and finds investors to generate those funds, and once the bonds are issued, the issuer has to pay the investor the yield on the bond, and then they have to return their principal. So how do bonds work? When they're issued, there's an agreement to pay a fixed amount of money for a fixed amount of time. That fixed amount of money is known as the principal, and that fixed amount of time is known as the maturity. Bonds are always paid out except when there are any financial woes by the bond issuer. Bank loans always set precedent to bonds, so if a company goes insolvent, they will have to pay back their loans before they have to pay back their bonds. Bonds have varying yields and maturities. So yield, the yearly percentage return a bond provides, and maturity is the date that a bond's principal must be repaid by. Bonds are important to traders because they give us a way to trade interest rates. When yields go up, bond prices go down. When bond prices go down, yields go up. They have this inverse relationship. All bonds are not equal, though. U.S. Treasury bonds are considered the safest, risk-free bonds on the earth. Literally each payment that a U.S. government bond is backed by is the government's ability to tax the U.S. population. So if we start up at, say the 10-year government bond, that'll be the safest investment you can put your money into. And then from there are different risk parameters for bonds. Second up would be from corporations. So a different corporation is going to have a different bond rating. A blue chip stock like Apple is going to have a better credit rating than, say, a penny stock. So that's what you have to be careful for when you're looking at different bonds. They go from investment grade to high yield to junk. And then again, the riskier the bond issuer, the higher the yield. Something about bonds. So in a healthy bond market, longer duration bonds have higher yields than shorter duration bonds. This makes sense because you want to have more return if you're willing to risk more of your time. What this translates into is in a healthy market, the 10-year treasury is going to yield 2%, and the 30-year treasury is going to yield 2.5%. Those are kind of just made-up numbers that I pulled. Currently, I think the 10 years trading around 3.5 and some change, and then the 30 is trading around, we'll call it 3.75. So that's when we're in a healthy market. But when the U.S. government raises short-term yields quickly, the short-term yields will surpass the yields of longer-term bonds. This leads to a contraction of the U.S. economy. So in an unhealthy market, let's say the 10-year will equal 3%, but the 30-year only equals this 2.5%. That lets you know that investors are worried about the future. They're much more likely to, have some shorter-term risks. So that's why the shorter maturity bond will have a greater yield. If investors are going to invest in that shorter duration maturity, then they're going to want more yield than that longer duration maturity. When we see this yield curve inversion, there's a contraction of the U.S. economy. That means that the Federal Reserve is raising the federal funds rate. The liquidity is being taken out of the market. And this is not something that is good for the U.S. economy. This often leads to recessions, depressions, what have you. Looking down at this chart, you can see we've had some yield curve inversions in the past that have led to predictions of recession. We saw this in the early 80s, the late 80s, the early 2000s, before the great financial crisis, before the COVID crash, and then now we are currently still inverted between the 2-year yield and the 10-year yield. So what this means is the bond market is predicting a recession, and the severity of the recession depends on the inversion of the yield curve. You can see definitely an unprecedented level down here. We haven't had one of these in about 40 years, so there's a lot of uncertainty within the U.S. economy right now, and that is not going to bode well for investors that are going to be looking to go long only in bonds or in equities. So how do we trade bonds? Bonds are traded just like equities. If a price can be charted, it can be identified to find that trend. So let's take a look at a couple charts. So here we have the 7 to 10 year Treasury bond ETF. ETFs are the best way for retail investors to get exposure to bonds, and that is because you can trade bonds in a couple different ways. You can trade options on bonds, you can trade through ETFs, you can trade through futures, but you're going to have a lot of greater risk if you're trading through options or futures just because of the leverage that is behind those. So that's why I always prefer to recommend recommend ETFs for anybody that's looking to get some exposure. So going back to trends, here we can clearly see a pattern of lower highs and lower lows. That's a big downtrend from August 22 up until November 22. Pretty easy to see this is going down. Then we get a sort of sideways consolidation here in the later parts of 2022. Here's our resistance point up there. Here's our support right there. And then we see a pattern of higher highs and higher lows. And that continues up until December. We get a pullback right to our previous resistance, now turn support, and then we got a move higher. So just like you trade stocks, you can do the same thing. Trend alignment and trend following is fractal. It can be done in any asset that can be charted. And then same thing here is the TLT. This is the 20-year plus Treasury bond. Same thing. We get a clear pattern of lower highs and lower lows. Then we get a sideways consolidation. We get resistance. We get support. We get a breakout. And then we get a clear pattern of higher lows. And then we get higher highs. We get another higher low. And then now we're looking to see if price can make a move to higher highs. So the IEF, that's a good 10-year bond ETF. The TLT, that's a good 20-year plus ETF. And these are both backed by the U.S. government. That is who issues these bonds. Next, we have the LQD. This is the investment-grade corporate bonds. So if you're looking to get exposure to corporate bonds, this is how you could do it through this ETF. If there's one thing you noticed, the corporate bonds and the government bonds have very, very similar chart patterns. That is because usually, these interest rates are going to move together. You're not going to see a big disparity between one or the other. The only thing that's going to be the big difference is that yield, like I said earlier. The LQD, the investment-grade corporate bond, is going to yield you more than one of these U.S. bonds because corporations are riskier than governments. It's much harder for a corporation to raise money than it is for a government because governments can easily tax you. There are lots of issues for corporations to raise their prices. There's a lot of factors varying how much their earnings are going to vary. So that's why you'll see these higher yields on corporate bonds because of that uncertainty. So again, here's your pattern of lower highs, lower lows. We get support, we get resistance, and then we see higher low, higher highs, higher low, and we made another higher high. So looking at the 10-year yield, you should notice something between this 10-year yield and the IEF. So in October of 22, the yield made its highest high that we see. In October of 22, the bond ETF made its lowest low we've seen. So this is the inverse relationship between bonds and bond yields. And that is very clearly seen just by looking at these two different charts. In August, we see a pattern of higher highs and higher lows, and that's evident here with this trend line. And then after that, we saw the absolute high, and then we've been seeing a pattern of lower lows and lower highs from there on out. And this isn't something that's unique just to the 10-year. If we look at the 30-year, we'll see the same thing. There's your ultimate high in October, moving back to the bond ETF. There is your ultimate low in October. So that's just something to take into account. This is the clear identification that bonds and yields trade inversely. So how do you trade? How do you get exposure to bonds and to bond yields? So like I said, the IEF, that's just an ETF you can buy. It trades just like anything else, and then you'll get a monthly distribution to reflect the yield that you're getting. How you trade the interest rate of the 10-year yield is the inverse of the IEF. If you want exposure to the interest rate itself, you'll have to use futures for that, but I don't recommend that for any retail investors, to anybody new to the market. ETFs are amazing. There are so many different options with this technology. So instead of having to go and open a futures account and trade on margin, instead you can just buy an inverse of the IEF, which will be the exact same as the yield on that bond. So that's how you get exposure to interest rates. You don't have to short the IEF. You don't have to open a futures account and trade those interest rates directly. You can just trade the inverse of the IEF. And if we go to that chart, what's the ticker on that? We got TBX. So here is the 10-year bond yield. Then we go to TBX. You see basically the same exact thing. This is how you get exposure to yields without having to worry about opening any of those riskier accounts. And then TLT, same thing as the IEF, just with longer duration bonds. And here you see that higher distribution yield. Currently, the TLT will give you 2.68% yearly. The IEF will give you 1.96%. So that's how you see the longer duration bond maturities are going to give you that higher yield. And the inverse of the TLT is the TBF, same thing as the TBX, just for the longer duration bond. This is how you will get short bonds. So here's your 30 yield or 30-year bond yield. Go to the TBF, same chart. You're getting that same thing right there. And then finally, let's look at our corporate bonds. So here's the high yield corporate bond ETF. And this thing pays drastically more than those U.S. bonds pay you. This will pay you 5.33% a year, and that's paid out monthly. So that's where you can see, this higher risk asset, you have to get a higher yield for it. So one more thing I want to show you. Let's look at the 2-year bond like we were looking at before. So the UTWO, let's type that in here. Let's look at the yield on it. Let's see what our yield curve inversion is. So it doesn't show it, but if we go to this chart, you can see that the 2-year government yield is currently at around 4.2%. If we go to the 10-year yield, you're only getting around 3.5. So that is where this yield curve inversion comes into play. The yield on the 2-year is greater than the yield on the 10-year. So that is why this inversion is happening. We had this disparity between short-term yields and longer-term yields. There is a lot of tension in the U.S. economy right now, and that is why investors are demanding a higher yield for shorter duration bonds, because they don't know what's going to happen in this shorter duration time frame. It's much more likely that over the next 10 years, something great will happen. Markets will revert to their means, and everything will be fine. But right now, there's a lot of uncertainty, and that is why investors are demanding more for these closer duration bonds. So that's about it. If you have any questions on bonds, feel free to leave it in the comments. Like and subscribe, and thanks for watching.